Hi everybody, this is Peter Schiff. It is Friday, March 2nd, 2012. Last week, we got both the Obama administration and Mitt Romney coming out with their own versions of a new tax plan. And what I want to focus in on is corporate income, or the corporate rates. Now, Obama claims he wants to lower the rate to 28% from 35%. But he also wants to raise the dividend tax on the individual side from the current 15% up to 39%. And when you throw in the extra tax to finance Obamacare, it actually brings the corporate tax rate for higher income earners up to about 44 point something percent. So even though Obama is claiming that he's lowering taxes, he actually is raising them. But I really want to examine what the real corporate tax rate is in the United States, because you got to take the tax at the corporate level and then also factor in the tax at the individual level. Because remember, the shareholders own the company. The shareholders pay the tax. They pay some of the tax at the corporate level, and then they pay the remainder of the tax at the personal level. But also, you have to bear in mind that just because a company earns money doesn't mean the shareholder gets it. You see, the shareholder gets what's distributed in the way of dividends. That's his share of the cash flow. And companies don't pay out everything they earn after tax in dividends. They have to retain money to grow the business, to replace depreciated equipment, to invest in research and development, new technologies, to expand and grow their business so they can continue to perpetuate that cash flow. And the difference between what they pay and what they retain is usually expressed as a ratio. It's called the dividend payout ratio. And in America, most corporations that pay dividends pay 30 some odd percent of their earnings in dividends. So I want to use an example, and we're going to assume a 40% payout rate, where a company earns $1 and then pays 40% of it to the shareholders and keeps 60% to grow the business and reinvest and have cash on hand. Let's examine the government's take from that and the owner's take. Well, the government takes its corporate tax right off the top. So today it gets 35% right off the top. And then if you take a look at the distribution to the shareholders, the government gets 15% of that, and the shareholders get 85%. So if you examine the cash flows, the distributions, under current law, for $1 of distributed profits, where some gets distributed to the government and some gets distributed to the shareholders, the government gets, I wrote this down, 64% of the cash flow. The shareholders get 36% of the cash flow. That's the current law. 64% to the government, 36% to the shareholders. Does that seem fair? Does that seem right? The shareholders take all the risks, right? They put up all the money, and then when they split up the cash flow, they get 36%, and the government gets 64%. That's the deal. I mean, does that sound like capitalism to you? Now, under the Romney plan, where Romney lowers the corporate tax rate to 25% and leaves the individual rate at 15%, it gets a little bit better. It's 54% of the cash flow going to the government, and 46% going to the shareholders. Still, more going to the government than the shareholders. Does that seem fair? Not at all. Now, if you look at Obama's proposal, under the proposal by Obama to lower the corporate tax, the government share of the distributions, assuming a 40% payout rate, goes up to 72% for the government and only 28% for the shareholders. Government gets 72%, the shareholders get 28%, and this is capitalism? This is freedom? I mean, how is this fair? Let's compare this to an actual communist country, right? China. In communist China, the corporate tax rate is 25%, which is where Romney wants to bring ours down to, but the dividend tax is only 10%. So neither candidate gets the taxes down in capitalist America to as low as they are in communist China. So if you do the numbers in China with a 40% payout rate, the government gets 51%, the shareholders get 49%. The shareholders get a much better deal in communist China. Now, sure, the government still takes 51%. Hey, but they don't pretend to be capitalists, right? They're admitting that they're communists, and they're taking 51%. Obama says we're a capitalist country, Yet he wants to take 72% because the 64% isn't enough. But you know, Hong Kong is part of communist China. The corporate tax in Hong Kong is 16.5%, and the individual tax is 0. So if you do the math in Hong Kong, which is part of communist China, the government gets 33.4, or the government gets 33% of the cash flow, and the shareholders get 67% of the cash flow. That seems a lot fairer to me, right? Where the government gets only a third and the shareholders get 2/3. Now, of course, none of that is as fair as the way it used to be in America. Let's say back in the 19th century when we really were a capitalist country and the government got 0 and the shareholders got it all because there was no corporate income tax and there was no personal income tax. That's freedom. That's liberty. That's the kind of country that I would want to live in. But you know, it actually gets worse. Think about this. The income tax is just one take that the government gets from corporate income. Think about all the other taxes corporations pay. What about payroll taxes? You know, the FICA taxes. For a lot of big corporations, I bet their FICA taxes exceed their profits. 100% of that money goes to the government. None of it goes to the shareholders. Think about this. What about all the taxes that the employees of the corporation pay? All that money goes to the government. All the income taxes that are paid through the income of a corporation, right? All that money is sent to the government. So think about all the money that the government gets when a corporation earns a profit or because a corporation is in business. Not only does it get the income tax for the corporation, but it gets all the payroll taxes that the corporations withheld from their workers, and it gets all the income taxes paid from the workers to the government. Much of that, of course, is withheld from the company and then shipped to the government. If you compare all the money the government takes out of a corporation versus all the dividends after tax that the owners take from a corporation, my guess would be the government gets more than 90% of the cash flow. Probably more than 95% of the cash flow from every U.S. corporation. So I put this to you. If our government really was communist, and they really believed in communism and not capitalism, would they do anything differently than they're doing now? I mean, would they actually nationalize the Fortune 500? Would they seize control of these corporations? What would they gain? They would lose. They couldn't get more money out of American companies than if they nationalized them themselves. I mean, any communist anywhere in the world would drool with envy over how much money America government is taking from our companies. Because if America actually seized these corporations, they'd still have to run them. They'd still have to pay people to run them. But of course, they wouldn't be run nearly as good. They wouldn't be nearly as profitable if all the employees were working for the government as opposed to being under the delusion that they're working for themselves. Now, there's a name to this type of economic system, and it's called fascism. You see, the difference between fascism and communism, which are both forms of socialism, is that at least the fascists are smart enough to know that if you seize the means of production, the government is going to lose revenue because the people aren't going to work as hard when they think they're working for the government. But if they think they're working for themselves, they'll work a lot harder. So the smart socialist knows that fascism serves the government more than communism because it allows the government to generate more revenue and thus be a more powerful force. Some people might want to take a look at my analysis and say that it's flawed because they're going to say, well, first of all, Peter, not everybody is paying the top personal tax rate. Certainly under what Obama is proposing, only the top income earners are going to be paying 40% taxes on their dividends, that plenty of people are still going to pay 15%. And of course, you know, on the Romney plan, there are people that aren't going to be paying 0. That's true, but I think the overwhelming majority of these corporate shares are held either by higher income individuals, or they're held in IRAs or pensions. And what that means is, though there's no tax paid today, ultimately there's going to be a tax paid on those dividends when they're distributed to the beneficiaries, and then they're going to be taxed at the ordinary income tax rate, which who knows what that rate might be. It can certainly be higher than what the dividend tax rate is right now. But part of my analysis is to focus on the upper income people who the president and many people say aren't being taxed enough. So I'm really focusing on, if you're an upper income person and you happen to own stock in a company and you're taking a dividend, what percentage are you paying in taxes to get that dividend? And that's where my analysis really fits in. And of course, when you take the other part of it, where you add to the government's take all of the payroll taxes and the personal income taxes and look at it in totality, then it doesn't even make a difference. Because as I said, I think the payroll taxes and the income taxes paid by employees are many times greater than the total profits that most of these companies earn, let alone what those profits are after tax. Also, people might think it's not fair to just look at the dividends that are paid. They might say, but Peter, you're ignoring all the retained earnings from the corporation. Well, I'm not ignoring them. Those retained earnings are there to grow the business so that future dividends can be paid out of which the government is still going to take its take and individuals will take theirs. The fact of the matter is, if companies don't retain any earnings, they can't survive. Not only can't they grow, they can't replace the depreciated equipment. So in order to survive and perpetuate the dividend streams, they have to retain earnings. That's just how corporations work. Now you might say, well, but the capital gains is there. The stock might be appreciating in value. Okay, sure. But what good is that appreciation if it's not cashed in? Either the shareholder has to take his portion of the gains in a dividend, or he can cash them in and sell. But then if he sells, he's going to pay a capital gains tax. So there you're still factoring in a tax that's going to be paid even if the unpaid out dividends are ultimately capitalized in the form of a sale. Then there's a capital gains tax, and it then depends on what that capital gains tax rate is. If the capital gains tax rate is lower than the dividends, then it will skew it a little bit. But who knows? I mean, maybe the capital gains tax rate is going to go back up. But the bottom line is, if you look at the total tax burden placed on corporations, but most importantly, if you look at the distributions that are paid, that is key. Not what the company retains or capital gains that may come in the future and might not. What really counts is the current income that stocks generate, both to the shareholder and to the government. And under our current system, or under either of the systems proposed by Obama or Romney, the government's take exceeds the shareholder take. Anyway, that's the truth. That's it for today. Again, don't forget to listen to the Peter Schiff Show every weekday from 10 a.m. to noon, Monday through Friday, again, at schiffradio.com. Bye for now.